Capital is racing ahead of workers at a speed most economists never saw coming. And the top reason is something almost nobody guesses. Stay tuned as we count down, and you'll discover why number 1 will change how you view the whole economy. Automation of routine tasks is the silent engine driving the capital surge, replacing repetitive labor with machines that never tire. Companies invest billions in robotic arms and AI software that can assemble, sort, and inspect products faster than any human crew. This shift slashes operating costs, boosting profit margins while leaving many workers on the sidelines. The ripple effect spreads to suppliers, who also adopt automated logistics to stay competitive. Up next, we'll see how financial markets are feeding this momentum by rewarding firms that embrace technology.
Financial market favoritism fuels the capital advantage, as investors pour funds into firms showcasing high automation scores. Stock analysts highlight efficiency gains, driving share prices up and granting these companies cheaper capital. This creates a feedback loop. Higher valuations enable further tech upgrades, which in turn attract more investment. The result? A widening gap where capital-rich firms accelerate while labor-intensive competitors lag behind. Coming up, we'll explore how global supply chains have re-engineered profit flows.
Global supply chain optimization is reshaping profit distribution, allowing capital to stretch across continents with minimal human oversight. Advanced forecasting algorithms predict demand spikes, while automated warehouses dispatch goods at lightning speed. These efficiencies cut inventory costs dramatically, letting firms reinvest savings into capital-intensive projects rather than wages. As a consequence, labor-heavy regions see fewer job openings despite rising consumer demand. Next, we'll uncover how the rise of gig platforms is redefining work itself.
Gig economy platforms are turning labor into a variable cost, giving capital owners unprecedented flexibility. By classifying workers as independent contractors, companies avoid traditional benefits and payroll taxes, squeezing profit margins tighter. This model scales quickly, letting capital flow into new markets without the burden of a permanent workforce. The downside? Workers face income volatility, while capital enjoys amplified returns. Stay tuned, because the next factor shows how education, or the lack of it, feeds this imbalance.
Skill gap and education lag are widening the capital-labor divide, as many workers lack the training required for high-tech roles. Employers prioritize candidates proficient in data analytics, AI, and robotics, often offering premium salaries that still undercut overall profit gains. Meanwhile, education systems scramble to update curricula, leaving a generation underprepared for the new economy. This mismatch forces firms to rely more on capital investments than on expanding their labor pool. Up next, we reveal how tax policies are subtly tipping the scales.
Tax incentives for capital expenditure are a powerful catalyst, encouraging businesses to pour money into equipment, software, and infrastructure. Governments worldwide offer accelerated depreciation and credits that lower the effective cost of investment, making capital projects more attractive than hiring. As a result, firms accelerate automation while labor growth stalls. This policy environment not only boosts shareholder returns but also reshapes the competitive landscape in favor of capital-rich entities. Coming up, we'll examine how demographic shifts are influencing the balance.
Demographic aging is quietly shifting the economic pendulum toward capital as a growing share of the population exits the labor force. With fewer workers available, businesses turn to automation to maintain output, investing heavily in machines that can operate around the clock. This trend amplifies capital's share of GDP while wages stay compressed for the remaining workforce. The aging curve also pressures governments to fund pensions, diverting fiscal resources away from labor-focused programs. Next, we'll see how corporate profit-sharing models are changing the game.
Profit sharing and stock options are redefining compensation, turning a slice of capital into employee benefits. While this aligns workers' interests with shareholders, the majority of gains still accrue to owners of large equity stakes. Companies use these programs to attract talent without raising base wages, effectively substituting labor costs with capital-based incentives. This strategy boosts productivity metrics but also cements the capital-dominant hierarchy. Up next, we'll explore how technological innovation cycles accelerate this disparity.
Rapid technological innovation cycles are compressing the time between invention and deployment, giving capital owners a decisive edge. Breakthroughs in AI, quantum computing, and nanomaterials move from prototype to market within years, not decades. Companies that can quickly fund and scale these technologies reap outsized returns, while labor markets struggle to keep pace with the required skill sets. This acceleration deepens the capital-labor gap, as profit growth outstrips wage growth across most sectors. Finally, we arrive at the most fundamental driver of this trend.
Capital accumulation advantage is the ultimate engine propelling the current economic imbalance, as wealth begets more wealth at an exponential rate. Large investors and corporations can reinvest profits into higher-yield assets, outpacing the modest growth of wage-based income. This self-reinforcing loop enables continuous funding of automation, research, and global expansion, further marginalizing labor's share of the pie. The result is a pronounced shift where capital not only outpaces but reshapes the very structure of work, leaving policymakers and workers scrambling to adapt.
What a ride! Seeing how capital's relentless climb is pulling ahead of labor really puts the whole economic puzzle into perspective. If you enjoyed this deep dive, hit subscribe so you don't miss the next mind-blowing list we drop each week. Which of these 10 reasons struck you the hardest? Drop your answer below, and give this video a like if it sparked your curiosity. Thanks for watching.